Hi everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, thanks for tuning in to our latest market update and outlook video. And so this month's video, I call it the Rorschach test for the economy. What do you see when you see this ink blot? Do you see a wolf coming out to get you? Or do you see two angels maybe meeting up together in the middle there? It depends on your outlook and where you are and your attitude and things. So the same thing appears to be happening with the economy. I'll tell you a little bit more about what I mean by that and what's going on and my outlook as always. So let's get right into it. All right, let's get started with the asset class returns for the month of April. When you look at this chart, you think, oh, well, a heck of a lot really didn't happen in April, but man, would you be wrong. We had a lot going on in the month of April. At the end of April, we were only down 0.68 on the S&P 500, which is pretty amazing because after Liberation Day and shortly after that announcement on April 2nd into April 9th, we were almost down 20% in the S&P 500 year to date. It didn't quite get to that. It was very close. It's pretty amazing that we only are down about 4.92% year to date in large cap stocks. Small caps have taken a little bit harder. As you can see, they were down 4%, so a total of 12 plus for the year, so a little bit more economically sensitive. The recession, the R word, is starting to come up a lot more, so people are concerned about what the tariffs could do to the global economy, especially the smaller cap stocks. Real estate has held up a little bit better. It's actually up for the year, but it took a little notch down for the month. But again, the big surprise has been international stocks. Nobody was talking about this at the beginning of the year. They have been a good deal for a long time, but they've been a good deal for like the last 15 years. So when were they going to start to come back? It looks like they're starting to do pretty well now. The big jolt has been the dollar has weakened, so that has helped anything that is denominated in non-US dollars go up. So you can see emerging markets has done okay, but especially developed market international. There's a lot going on, as we talked about, with Germany spending more and Europe spending more for their defense and infrastructure, and that's kind of given their stocks a little bit of a boost. We shall see if it stays because the earnings in Europe still really hasn't been very good. So that's something to keep an eye on. Fixed income ended up positive, which is a miracle because we actually had a huge jump in treasury yields, which makes bond prices go down. But then towards the end of the month, it steadily came back down. We'll be talking about why and the 90-day pause and everything that happened there. High yield was actually up a little bit, similar to the bonds. And commodities in general were down. Okay, now that's mostly oil and the other precious metals. Gold was actually pretty good again for the month of April. So that's been actually holding up the commodity space, but oil has been down considerably. Again, the R word is not great for oil and some of these other commodities. And it looks like OPEC is kind of in a little fight right now where they're producing a lot more. And so that's actually been helping oil prices go down as well. All right, as we talk about what's going on in the market, I always like to give you the actual economic numbers that show you how the economy is doing, and I call that the Big Three report. We got the ISM manufacturing, services, and the employment report. And so on the ISM PMI manufacturing, we actually had a number of 48.7. That's not too bad. It was actually a little bit better than expected, and it was a little bit lower than last month, but almost identical. So that one actually was kind of a Goldilocks number. But again, it's kind of low. When it's under 50, we are contracting. So that's not the greatest number, but again, in line. The services number doesn't actually come out till May 5th. So last month was 50.8, so we're expecting something kind of in that range. If it does drop below 50, that is something that I'm going to be looking at very carefully because that's a big part of our economy is services, and that would show the first sign of contraction in that number in a long time. If it stays above 50, then we're kind of again in that Goldilocks zone, so we'll have to see. And today, I'm filming this on May 2nd, Friday. We actually had the jobs report today. The expected number was 135,000 new jobs and the unemployment rate to stay the same at 4.2. We actually got the number at 177, so it was actually a pretty decent surprise on the upside. So, and the unemployment rate stayed the same. So when people are employed, people tend to still spend, and it keeps recession at bay. So this is a good sign that, maybe that recession story isn't as close as maybe some of us were thinking it could be. Now, it's not at all clear, I don't think. We still show the initial claims number this Thursday that came out just yesterday did bump up a little bit, and that number is a little bit more of a leading indicator, where the unemployment report's a little bit more of a lagging indicator of last month. So I am watching that. That's starting to show a little sign of weakness. But overall, as you can see here, the economy still looks like it's in a pretty firm footing. All right, I don't always bring up the GDP report, but I thought I would because it actually showed a negative GDP print for the first quarter, and I figured that's going to be all over the news, so I just wanted to make sure to give you a little color behind this report. And so what we see here is we had a negative 0.3% in real GDP, and that sounds bad because if you have two negative prints of GDP, that's technically when we go into a recession, and there's a lot of concerns about that. But what I want to point out here, and this chart breaks down the different components of GDP, is look at the imports here. This was a 5% net import number. Okay, this is massive. This is one of the biggest import numbers I think we've ever seen before. Okay, and as you can imagine, if there's tariffs coming, or if people are anxious about tariffs coming, what are they going to do? They're going to front run. They're going to buy all these goods from all these different places and import them and store them in warehouses, and it's going to be added to their inventory eventually. And so the way the GDP is calculated, they actually take all these other consumer spending and investments and government and exports, and they subtract it from the imports. And so it kind of makes it look like we had a really bad quarter, but was it really a bad quarter? I would say that probably not. And what's going to most likely happen is next quarter, you're going to see a lot fewer imports, right? Because maybe the tariffs are going to start biting into some of this. And there's going to be probably a much higher GDP number that's kind of undeserved because the imports were all front run in the first quarter. So when we see a GDP quarter two that looks great, we also have to look at that with a grain of salt too. All right, so let's talk real quick about inflation, because I know the big concern in the marketplace has been stagflation, where you get slow growth, and inflation. So how's the inflation part going? Well, as you can see here, the PCE, again, that's the Fed's favorite inflation proxy, was for the month of April, it actually showed that it was flat, 0. Okay, that's actually really, really good. 0 inflation. Year over year, 2.3%. You can see it kind of coming down here. That's really, really good because it's kind of been stuck here for a little while. And then the core PCE, where you strip out all the volatile food and energy kind of prices, it was up barely. Okay, 0.1. Some reports show it as 0, and it was 2.6%. year over year. So again, both of those numbers coming down. So it looks like the deflation part of stagflation is not really showing its teeth quite yet. With tariffs coming, maybe that will start to creep up. There is a possibility that could happen. I'm still more in the camp that I think if the tariffs stick around, and that's a big if, we don't know what's going on there, and hopefully they're going to start to come off as we get trade deals, that is going to slow down growth, if anything, and not so much create a lot of inflation. So that means that the Fed could potentially come in here and maybe do some rate cutting. We'll see. All right, now for the chart of the whole video. This is my consumer sentiment chart. Now I want to talk about this because the consumer sentiment has been extremely negative. You look at the Conference Board and the University of Michigan polls or surveys, and they show numbers that we haven't seen really since the great financial crisis. Definitely as bad as it was, maybe even a little worse than COVID. And so I wanted to break that down a little bit because what we're seeing is actually a very interesting dichotomy between people that answer as Republicans and Democrats. So I thought this was really, really interesting. The University of Michigan poll actually breaks this down. You can see how after the election, obviously the Republicans were very excited. Their sentiment went up. And it's been kind of flat here lately as we've been talking about all these tariffs. But when you look at the Democrat side, it's been very negative. In fact, you can see it's lower than it was during COVID. And so this is an extremely negative move. And so it depends on your political affiliation is how you see what's going on right now with the policy, with the tariffs. And so that's why, I use this whole Rorschach test. What do you see? It depends on the eye of the beholder here. But the bottom line of what I really want to show you when it comes to sentiment, whenever it gets this negative, it's very much a contrarian indicator. When you see the consumer sentiment get this low, it's almost always a very good buying signal. So I also wanted to turn the whole piece around and say, hey, there's an opportunity here where when everybody's kind of sour on things, or at least a lot of people are sour on things, it might be a good time to go in and grab some good deals, especially if you have a longer term time frame and a little risk to go along with that. All right? All right, for the outlook, I wanted to explain what I'm seeing with the move with tariffs and the Trump administration. I do believe that it does appear like they are responding to what the market has been showing them. And that's a really good sign because at first we didn't think that they were going to be very responsive because part of it was they were saying they didn't really look at the market and they weren't really watching it very closely. But it does look like they are. So let's get into that. All right, so why do I think that the Trump administration is actually responding to the market? So first of all, and probably the most important one, is the first one. They had a 90-day pause of the reciprocal tariffs. Now, this happened right around April 9th. You guys probably remember that was the day the market went up 10+%. And it happened in a flash. I mean, that was amazing. I hadn't seen anything like that before. This is why you don't try to time the market. The market can move 10% in 1 second, okay, which is basically what happened. But really, what was the underlying reason? Okay, I believe it was the Treasury market. It was doing some really wacky things. Rates were going way up, even though things look bad for the economy, potentially with these tariffs, and it usually goes the other way around. And so it just looked like people were just selling the Treasury market, selling dollars. It looked like everything U.S. was being sold. I think that probably got the attention of the administration, and somebody told Trump, hey, you better put a pause in here, have some conversations here, give people more time. And that's exactly what happens, and you could see how the market responded. Okay. Also, we're adding exemptions, and especially adding exemptions for China tariffs. So that's another sign that they're, even though we've been, in a pretty tough war with tariffs with China, that they're making exemptions and China's doing the same thing. So obviously this 145% tariff rate is not where we want to end up. This is the starting point, and they're starting to make some accommodations. We're seeing that already. They're also making credits and making exemptions also for auto manufacturers. Okay, so the auto manufacturers are really getting hit. They're getting the steel, aluminum tariffs. They're getting the auto tariffs. They're getting the car parts tariffs. I mean, they're coming back and they're saying there's no way we can bring everything back to the U.S. in the next 90 days. You got to give us more time. And so you're seeing the administration starting to give them credits, exemptions, give them a year or two where it starts to phase out these credits, trying to give them an opportunity to actually do this. So that makes a lot more sense. They're listening to the marketplace there. And then the other one I would say is there was some talk from Trump specifically about, telling Jay Powell he needs to lower rates, and if he doesn't, he's going to terminate him. And at least it appeared that he was saying that. I'm sure he'll say he didn't say that exactly. You know how it is. And the market actually really took that in a bad way. You again saw a little bit what we saw during the 90-day thing where there's a lot of, the dollar was going down, treasury yields were going up, and then a couple days later they retracted that, and then the market just kind of came back up again, yields came down, things softened up again. Okay, so they're again responding to what the market is doing. And then the last thing is the fact that they're talking about hoping to make trade deals sounds like they don't want to have those excruciatingly high tariff rates stick, right? That was the opening salvo so that they can negotiate them down lower. So the fact that they're responding, the fact that they're making exemptions, credits, and they're also emphasizing deals means that their goal wasn't to keep these rates as high as they were. They're trying to bring them down, hopefully trying to get better deals with these other countries. We'll have to see. There's a 90-day window, and as that 90-day window gets closer, it's going to get a little ugly if we don't have any trade deals. This is something I'm going to be watching out for very closely. But if we start getting some trade deals, even they start to build up little by little, that could be very positive for the stock market. And the stock market's kind of anticipating a little bit of that. That's why we've seen a little bit of a comeback here recently. So that's something that we'll have to see, because if not, these tariffs are going to stick, and they could be very harmful for not just the U.S. economy, but for the global economy. All right, so what are the Heartwood implications after we look at the update and outlook and everything going on? Overall, I'm still pretty neutral with the portfolio. Again, things are very dynamic here. Things can change very quickly, so I didn't want to get too bearish or too bullish. But I am on the edges, kind of taking a little bit of risk off the table. We're lowering small cap. Something new here, I'm starting to reduce China exposure. I think that unfortunately, that negotiation is going to probably take a little while, maybe get a little worse before it gets better, unfortunately. Adding to large cap, a little bit more stability, adding to emerging markets, but ex-China. So that's going to probably involve more India and some of these other Asian countries that may get more favorable deals than China as we start to try to diversify our supply chains. And the same thing with bonds. We're lowering the longer term bonds, adding to floating rate bonds. I still don't see us in a high probability or the highest probability of recession. I still see more of a soft landing and then a reacceleration into the last part of the year. And so I want the higher interest of those bonds, where longer term government bonds tend to be really good for recessions, which I don't see that as the highest probability. But also adding a little bit of cash just in case, especially from the small cap, to have a little dry powder in case other opportunities come our way. All right? So I hope this helps, guys. I know that was a lot, so please feel free to reach out if you have any questions. And please feel free to share this video. But thanks again for watching, and God bless.